All right. All right. Well, welcome everybody. As people are getting connected here, I will say Happy New Year. It's Mark Yusko from Chapel Hill. And I know we're on the verge of when you can't say Happy New Year anymore, but since I haven't seen most people here, indeed, Happy New Year. And we're here today to do our around the world 10 potential surprises for 2025. And as a reminder, I got too many slides. We're going to review last year. I'll go really, really fast through last year. You guys can look at the slides at your leisure, and then I'll spend some time on the new surprises. So, definition, disclaimer, disqualifier. Surprises are not predictions, but variant perceptions. We think there's a better than 50-50 chance they occur, but some of them won't. The idea is that I haven't read anyone else's surprises, so if they happen to resemble Byron's, I don't even know if he's still doing his. He probably is, but there's no similarity there. Much wisdom about the folly of prediction, but I actually like this process. I really like thinking like there is no box at the beginning of the year. So make predictions is hard, especially about the future. Markets are unpredictable. You have to have scenarios. The idea that you could actually predict what's going to happen goes away. My way of thinking about the market from Mr. Soros, and markets are consistently in a state of uncertainty and flux, and money's made by discounting the obvious and betting on the unexpected. So that's the whole idea. If you think about what a surprise is, and a contrarian, it's not about being contrarian. It's enough. You got to be contrarian and right. That's when the big money is made. So those who have knowledge don't predict. Those who predict don't have knowledge. I always love that one. All right. So a year ago, Mag 7 were stampeding. Stocks were at all-time highs, despite the fact that our shape-shifting Fed chair morphed back into Jerome the Hawk, raised rates, and Baby New Year was suited up for a rough year. So scorecard 5 and 6, a little less well than we would have liked. Consensus and momentum really beat out the contrarians this year. So a year ago, these were the consensus. The global GDP would be 2.5 to 3. That was close. U.S. would avoid recession, and it did. Fed would cut rates by Q2. That was pretty darn good. It didn't happen in Q2, but they did cut rates in Q4. S&P makes new all-time highs. Bonds are back. Not so much. Inflation stays cool. Nope. We never got back to the 2% target. Diversification. Nope. All about mo. Japan. Yeah, that was good. India beats China in growth. Sure. And geopolitical risk was on everybody's mind as the big risk. Surprise number one, paint it black. So, last year surprises, they all came from the Rolling Stones. Surprise in 2024 beat everyone, and we do mean everyone, is certain the call sign J. Powell engineered perfect soft landing. The economy quietly paints it black and slips into recession. It's just wrong. He did pull off the perfect no landing. GDP grew nicely all year. Adding fuel to the problem or fire, money supply and global liquidity led by China, turned positive, and growth globally actually jumped. So it didn't go there. So soft landing was consensus. Probability of recession was pretty high. Druckenmiller indicator said, hey, we actually were in recession. We just weren't calling it. If you looked at the heat map, it's pretty ugly. I mean, lots of red on the far right. Recession needed unemployment to rise. Too many people were working to call it a recession. Historically, global financial crisis happened around housing crisis. So if housing crisis were to have happened, and if you're trying to buy a house, you might say our housing crisis already has happened. But investors believe that the corporate cash would counter the housing, and therefore you have a soft landing. Credit card debt was a problem. Credit card costs were an even bigger problem. But it's extend and pretend. Well, that went away, so people had to file bankruptcy, but it's not as bad as it used to be. Now, look, the yield curve inverts. Usually recession is 12 months away. GDP now said not yet, and GDP now was right. growth was about 2.4% in 2024. There's still some upside if they revise Q4 higher, but it's a pretty good year. So surprise number 2, tumbling dice. Surprise would be that economic activity never wanes enough to warrant rate cuts. Market euphoria caused by lower rates fades. Well, we were half right, but wrong. GDP never did wane, but for some unknown reason, the chairman did shapeshift back into Jay the Dove, cut rates 4 times in the second half, despite 2.5% growth. That has never happened before. Market euphoria continued its relentless surge higher. Now, money supply growth had gone negative, so maybe that was the problem. You know, the only analogy was the 1940s. You want to avoid that. The downward trend in interest rates seems to have broken. Everyone thought we'd cut rates 7 times last year. Didn't happen. The Fed usually cuts in recession. Therefore, if the probability of recession was 0, why would they cut rates? Don't know. The Fed did respond and cut rates. And what did people do? More stocks. So we now have the highest level of allocation to equities in the history of allocations to equities. Interesting. All right. Surprise number 3, wild horses. The surprise in 2024 would be that the wild horses throw a shoe, the Mag 7. Economic growth wanes, lower rates never materialize, and valuations come back to earth. Dead wrong. The trifecta of wrongness here. Economic growth never waned. Central banks cut rates like there was a global financial crisis. And equity valuations surged to new levels of crazy. Make it make sense. So the Mag 7, everybody's familiar, Apple, Microsoft, Alphabet, Amazon, NVIDIA, Meta, and Tesla replaced Fangman as the Mag, the ones to talk about. Early in the year, it had gone to the Mag 2. Basically, everything else was going down. Tesla was in free fall. And it was really just Apple and Microsoft that were going up. Look, the Mag 7 is larger than every global market outside the U.S. and 4 times larger than the Russell 2000. So investors buy what they wish they would have bought. So it became the most crowded trade. And, everybody was greedy. Investor sentiment hadn't been this high since 2014. Speculators were net long triple Q, highest ever. Interestingly, more stocks in the S&P underperformed, therefore huge dispersion. But ISM was telling us, hey, earnings are going to fall. But analysts, as they are prone to do, said, oh, no, don't worry. Earnings will rise. They never did get there, but no one cared because AI mania. So AI, that's the perfect quarterly earnings call. Just talk about AI. And look, it's real that ChatGPT got to 100 million users faster than anything else. Okay. But NVIDIA added $1 trillion of market cap and then added another 2 trillion. But yes, their revenue, income, and margins all did explode. But if you think about it, someone's paying for that stuff. So if their margins and revenues are going up, well, then maybe companies like Microsoft are basically evaporating their free cash flow, buying a bunch of Blackwell chips. And Apple started egregiously overvalued, and it actually got worse, even though sales growth went to 0. Again, make it make sense. So as January goes, so goes the year. Tough start to January. Au contraire. So we busted that indicator for the first time. Now the Mag 6, Microsoft did lag. Microsoft had a tough year. Now, tough meaning it was only up 15%, but on average, the Mag 7 was up 64%. So jumping jack flash, surprise number 4. The surprise would be the Dawn of the Dead movie. You can't keep a good zombie down. The Return of the Rising Bond Yield Zombies knocks over the punch bowl just as the party was getting good. Yeah, we were right, but literally no one cares. Despite J-Pow's shape-shifting back to dub mode, cutting 100 basis points off the already too low Fed funds rate, the 10-year and the 30-year rates surged 20% higher. Crazy. So ask a dozen people where rates were headed, you get 13 answers. The Fed funds doesn't stay above inflation for very long. So with inflation coming down, Fed funds needed to come down. That made sense. Long rates were at an inflection point. They did not hold that inflection point and got crucified. If the Fed were to pivot, people were concerned that it would trigger 1970s redo. And actually cutting into economic strength, one would think, would cause more inflation. Okay, logical. The zombies actually were in full retreat up until the Fed cut rates. Then, inexplicably, although I'll explain later, rates actually rose from October to December. Illogical, but we'll talk about it. Surprise number 5, start me up. Surprise in 2024 is the Fed starts the money printer back up, becomes the buyer last resort. The dollar falls more. We were 75% right, but dead wrong. The chairman did turn the money printer back to Burr, not maximum Burr, but Burr. M2 growth shifted back to positive. DXY struggled all year until October 1st and then went totally ballistic on Trump tariff threats. So the long-term decline in the dollar is still intact. And you have to remember that the DXY is really just all about the yen and the euro. It's really mostly about the euro. And if you look at that, yeah, the yen was thrashed, as it is prone to do, and the euro was basically flat. U.S. debt has skyrocketed. Therefore, interest costs have skyrocketed. So from 659 billion in 23, now well over $1 trillion with a T dollars, taking up $1 out of every $6 that the government collects from us unlawfully. The debt deficit explosion caused the money printer to go burr. And I love the thing in the middle about how long it takes to print $1 trillion. First trillion, 199 years. Second trillion, 8 years. The 22nd trillion, half a year. The reality is too much debt has to be refinanced. Therefore, we can't afford higher rates, which is why they had to eventually cut rates. But the problem is longer rates went up. So how are they going to refinance the debt? Well, they're going to have to keep it short, which means there's probably going to be more pressure on short rates. Jerome the Hawk did massive damage to bank balance sheets. So this is also a form of bailout for the banks, and Goldman Sachs showed us that this morning with their earnings. So quietly, emerging market currencies kind of came back in favor. Is King Dollar's reign over? Not yet. Now look, we were on track. 3/4 of the year, the surprise looked great, and then bam, just smacked down, and tariff fears piled on. The question remains, is the dollar the tail or the dog? So the yen pounded, euro pounded. So did the dollar actually strengthen, or did these other currencies just super weaken? I think we're going to find out that they just super weaken and the dollar's really not that strong. All right. Can't always get what you want. Surprise in 24 would be that oil prices don't fall in advance of U.S. election, as they usually do. Demand keeps rising and prices creep back towards 100. Right early, again, this is the flip side of the last surprise, was looking good up until summer, and then bam. So the Saudi budget target of $91 was in play as oil hit $87 on April Fools. And then U.S. supply just kept hitting new records. Prices fell by election day, and nobody even had to mess with the SPR to get prices down before elections. Now, EIA always says prices will be flat. They always say the market will balance. U.S. production. I mean, this chart on the left is really a thing of beauty in the sense that chart on the right, they're using less and less rigs to get more and more oil out of the ground. It is an engineering marvel. So OPEC has basically had to reduce. Now, Saudi says they can turn on the spigots anytime they want. The reality is, I don't think they can get above 11 million barrels a day. So something could break if they were forced to challenge that 11 million barrels. Saudi needs 91 bucks. Strategic Petroleum Reserve has been drained. Midterm elections, so nothing left to sell. Long-term oil chart, super bullish, but it had to get back above the 200-day moving average. It did not. Oil and gas producers, dead money in the past year. MLPs, though, chef's kiss. This is the gift that keeps on giving. They just keep chugging out free cash flow and going up about 20% a year. Investors, the least long oil stocks ever. In fact, they were getting short at near record levels. And as usual, that extreme positioning was wrong until April. And then it was absolutely right when OPEC just completely lost control. So oil and gas operating companies surged early, faded hard. MLPs, they don't care about oil prices. They just keep generate free cash flow. All right, she's a rainbow. Surprise would be that like the scene in Thelma and Louise, Ms. Lagarde drives her pink Corvette off the cliff and European equities crash. That is my dream car. Not pink, but that particular Corvette. I love that car. Kind of right. The EU growth was indeed dismal. PMIs were, there's the typo, always three typos, were sub, not I sub, 50. Ms. Lagarde kept cutting rates 4 times in 24, passing out rainbows. Stocks tried to rally, but gave it all back in the second half. So ECB never raised rates faster. So was it too far, too fast? Well, she vanquished inflation, but she also vanquished a bunch of other things. So one of them being growth. Growth vanished. Germany, oh my God, Germany has had a really tough time. In fact, as of this morning, has entered an official recession. The EU economic outlook was fading. Growth is better than fading. And look, the psychedelics, they worked until October, and then the wheels came off. And look, in a year where global equities were up 20%, dead flat is bad. So surprise number 8, beast of burden. Surprise in 24 would be that the yen has to take a turn in the global central bank hot seat and strengthen, so Japanese equities struggle. Almost right, but wrong. The surprise looked dead on arrival until July. Yen then did get put in the hot box, went from 162 to 140. The Nikkei plunged 27% in 3 weeks. But then, Prime Minister sat Ueda-san down and said, bad boy, let's not do that again. So the yen went back to 158 and stocks rallied back to 40K. So demographics, aging population is the problem. GDP growth is going to be low for a very long time. So the only way out to get stocks to go up was Abenomics, which meant weaken the yen. And the Bank of Japan makes all other money printers look like pikers. Bank of Japan put the E in QQE. They take the buyer of last resort mandate seriously. They now own over 80% of all the JGBs, more than 100% of the on-the-run bonds. Abenomics is simple. Trash the yen, equities will rise, debt gets devalued. It's the only way you can survive. Japanese banks have been on a tear. Nintendo got back to its 2020 high. Look, the yen did on the left take a turn in the hot seat and stocks crashed. But then they had to go back to the old plan. So it worked out. All right, surprise number 9, ain't too proud to beg. Surprise would be that you should buy what's on sale. Never bet against China in the year of the dragon, and Chinese stocks roar. Mostly right. China pulled out the stimulus gun in April. Stocks jumped 20%. Faded over the summer. Then they took out the bazooka in September. Stocks went up 50%. There's another typo. I told you, there's always 3 typos. Then gave back 60% of gains on Trump tariff fears. So mostly right. Emerging markets, cheapest in 50 years. China, cheapest of them all. People were leaving China. People were just afraid to invest in China because of fears of of retribution. In fact, short China is the second most crowded trade. Look, since the Biden administration, China stocks have been punished. So it wasn't Trump that punished China. Despite all the rhetoric, Chinese stocks went up along with U.S. stocks when Trump was president. It was only when Biden came in that they got whacked. Now, the U.S. dollar weakened against the renminbi. That should have been a tailwind for local markets, but it wasn't. So Xi took the matter in his own hand, said, hey, I'll come and beg for new cash flows. It worked. Although China's stocks actually made new lows. Now, China tech was even worse in the sense that the government had attacked certain industries, Jack Ma in particular, and had punished stocks like Baba and Tencent, and particularly JD. But all of that was getting set to turn because they turned back on the PBOC spigot and cut lending rates. And what happened? China stimulated bigly. Rest of the world sold relentlessly. And China's stocks rallied quite nicely. In fact, higher than U.S. stocks. No one would believe that. All right, waiting on a friend. Surprise number 10. Surprise would be the party's just getting started as we enter mass adoption phase for Bitcoin. Prices rise relentlessly to more than 100K. Dead right on the money. Everything in the surprise played out according to script. Bitcoin ETFs were the most successful in history. Institution and nation states began buying, and Bitcoin hit six figures in December. So Bitcoin's the best asset over the last 10 years, and it's not close. High Sharpe ratio. Everyone's jumping in the act. BlackRock did an about face in June. Why? Because there's $30 trillion of money in advisor accounts that he wanted to get his grubby little hands on. And mania hit a frenzied level. It's not just U.S., everywhere, whether it's Luxembourg or Singapore or Switzerland, everybody wanted the boomer rappers to get exposure to Bitcoin. So, on the 10th, a year ago, spot Bitcoin ETFs were approved. But as they said, we do not approve or endorse Bitcoin. I love that. Now Gary Gensler's out. So all 11 were approved. Now, one of the things is buy the rumor, sell the news. So when the gold ETF was approved on the far left, it took 9 months before gold prices actually went up. Because what happens is they also approve futures. And so what the big speculators do, the big hedge funds, et cetera, they buy the ETF and they short the future against it. It's called spoofing, and it's very profitable for those firms. But the average retail investor kind of gets hammered. So Bitcoin fundamentals, though, kept going up, new all-time highs. The network value was approaching $80,000. So it was likely that Bitcoin was going to rally. Now, there's a seasonality to Bitcoin, 3 years up, 1 year down. So we're in the second year of that cycle. So we're going to have an up year. And, we have the inverse Kramer effect, where Jim said it's topping out at 44K. So we say thanks to JC. The halving event was the catalyst for a significant rally. We talked about that last year. Tommy Mustache said 105. Tim Peterson said 120. We did hit 107. That's pretty darn good. So we hit that 107 high, surged 120%, best performing asset class again. Surprise number 11, give me shelter. The surprise would be that global growth trends never get as bad as they think. Industrial metals rise, investors think, and still seek shelter in gold just to be double safe. So, right, global growth didn't disappoint. Commodities had a strong year. Some commodities went to new all-time highs like orange juice and coffee, but gold, surprisingly, beat stocks. Nobody's talking about that, up 30%. So hard assets never cheaper relative to paper assets. Surprising thing would be most people wouldn't believe that metals outperform S&P over the last 3 years. Crazy. So what do? They sell. People don't understand commodities, so they were underweight just at the time you should have owned them. Dr. Copper, not really impressed. It was kind of worried about trade wars. Commodity producers were starting to break out. Gold is money. Everything else is just credit. Huge cup and handle pattern that was setting up for a big year for gold, and it was. The miners, were super cheap. They looked like they were breaking out. They also had a good year. So sheltering in gold was quite profitable in 2024. CRB index, short TLT actually beat the S&P. It's an interesting trade. All right. So the 2025 surprises are brought to you this year by House Stark. Now, I've actually never watched Game of Thrones. That's not 100% true. I watched one episode. Oh, wait a minute. What happened here? One episode for 7 minutes. My daughter and wife convinced me to watch it. I happened to watch 7 minutes of Red Wedding, and like 22 people died. And I said, this is the dumbest show ever. So I never watched it. So someday I'll go back and watch it. But you'll see how the theme came about. But the House Stark is what this year's all about. So I asked ChatGPT to generate the consensus. Now, amidst the hallucinations, if you look at the chart, ChatGPT doesn't spell very well. It conflates words. But generally it got some stuff right. It, says Bitcoin's going to rise. It says global growth's going to be 3.25. And it says, stocks are going to be okay and alternative asset growth is going to be good, and fixed IMBDs means fixed income, treasury yields. So ChatGPT's got a lot of work to do, but it did on the text side give me a bunch of consensus beliefs. So US GDP, soft landing, 2% growth. Global GDP should accelerate 3.25. U.S. inflation above target at 2.5. The S&P average year with about a 12% return. Europe challenged by trade policies, which we'll talk about. Japan, rate hikes continue. Pretty good call since they had one this morning. And lower growth. China, headwinds from U.S. tariffs. Fixed income, no cuts. Yields stay over 4.5. So that's interesting. No cuts, despite the fact that people were still saying 2 to 3 cuts this year. Credit markets, limited upside for corporate and high yield. Oil price expected to remain stable. Shocking. Gold, uncertainty favors hedge. Right? So you should buy some. The dollar, of course, expected to remain strong because it's king dollar. Private equity, more growth, and crypto. Bitcoin could reach 250 because, well, of course, if it hits 100, it's going to go up to 250. So trade wars, inflation, and rising rates, oh my. Investors' biggest fears this year are a global trade war. Second is that AI enthusiasm peters out and growth stocks plunge. Third, central banks hike unexpectedly. Fourth, bond yields rise more than expected. Fifth, Middle East tensions escalate, and you can read the rest. So, surprise number one, unbowed, unbent, unbroken, which was an episode in Game of Thrones. So coming into Q4, J-Pow was celebrating his amazing no landing performance as inflation was falling, GDP growth was rising, stocks were making new all-time highs. Our beloved shape-shifting Fed chairman was everyone's superhero, and to further cement his legacy as America's favorite Fed chair, he went full dove, started cutting rates, despite all indication that rate cuts were unnecessary. With the bravado of a decorated fighter pilot, J-Pow echoed Civil War officer Farragut, saying, damn the torpedoes, full speed ahead, and hacked 50 basis points off the Fed funds rate in September, despite warnings from everyone that too much stimulus would lead to 1970-style inflation. Having vanquished the recession bogey, Jay wasn't going to be spooked by any inflation. The surprise in 2025 would be that running headlong into a minefield doesn't turn out as planned. Some things actually explode, and that long overdue recession finally arrives. Consensus is GDP growth and inflation accelerate in 25. Spending would seem to confirm that. U.S. GDP growth remains buoyant, estimates of about 2.7%. Inflation rising to 2.7%, and yields staying stubbornly high. Now, part of the reason is because the government is printing money to spend it. So they print money out of thin air. They don't collect enough revenue, so they just spend. And that is creating an illusion of growth. So that U.S. growth minus the deficit would be pretty anemic, but I guess it counts. So bond markets are telling Jay Powell that he chose the wrong button and that he's committed a policy error like the 1970s. And so I probably don't think we're going to go to double-digit inflation, although some would say we're probably already there if you believe the real inflation numbers or if you try to buy anything. But I probably agree that it was a policy error. Consumer credit collapsed the most since the global financial crisis. Now, what does that mean? It means that people stopped buying stuff with credit cards. Well, wasn't it the holidays? Weren't they supposed to be buying lots of stuff? Well, yes, they were. Usually, that is a severe sign of weakness because it's the last resort that people have when their earnings aren't growing or their incomes aren't growing. They resort to credit cards. So the fact that that retrenched is nerve-wracking. Bankruptcy filings don't rise during good times. Full stop. And there's a concern that credit spreads will soon catch up, and that would be bad for holders of things like high-yield bonds. Now, the central banks are cutting rates as if a recession was already here, yet in no way, shape, or form is there any evidence of recession. So why are they cutting rates so much? The data, on the right-hand side looks pretty good. 2.6, 2.7% GDP. I don't know why they're cutting rates so much. So surprise number 2, winter or printer is coming. Our beloved shapeshifter Jay Powell changed back to dove form last September, hacked 100 basis points off an already low, some say too low, given growth, Fed funds rate, but mysteriously shifted back to hawk formed during the December Fed meeting, prompting consensus to change from more rate cuts in 25 to 0 cuts in the new year. The real problem for the Fed is that the bond vigilantes have wrested control of the bond markets, and for the first time in history, a 100 basis point Fed funds cut was met with an equal 100 basis point increase in the 10-year and the 30-year yield. The bond market reaction was so violent that TLT, which has valiantly fought back to a modest gain for the year, by September, surrendered 13% in the final quarter to post double-digit losses for the third time in 4 years. You've now lost 50%, one half of the value of your long bond position over 4 years. It's supposed to be safe stuff. The surprise in 25 would be that Ned Stark was right. Challenges are on the way. Indeed, they are inevitable. And printer is coming is the only solution. So we are in the third great bear market in bonds. We're in the 6th year of that third great bond bear market. And it is putting huge pressure. Now we're up to $1.15 trillion of interest on the debt. So the Fed shapeshifts to dove, saying, I can fix it. So he cuts rates a lot, 100 basis points. And for the first time ever, the bond market says, hell to the no. No time in history have rates gone up at the long end of the curve when the Fed cuts, which is logical because usually you're cutting into a recession. That's not what he did. So TLT erased all the gains from the summer. In the middle of summer, holding bonds was looking pretty good. Now, what do humans do? Humans do two things really well. We buy what we wish we would have bought, and we sell what we're about to need. So massive outflows, the biggest outflow ever from TLT. I'm thinking maybe you should buy a little. So the 30-year just completed a DeMark 13 count. And for technical analysts, it's a famous guy, Tom DeMark. And you get these 13 counts, and you'll notice that there are no permanently higher plateaus, right? You get these spikes. And so, look, one day does not a trend make, but rates plummeted a lot today on the inflation data, and maybe, buying that TLT would be a good idea. Now, it's not only about rates. The balance sheet matters too. And, the not QE and the QE and the not yield control, the yield curve control, the bottom line is the Fed has been increasing their balance sheet at a lower rate, but still increasing. And so global liquidity and stocks tend to be correlated. So there's going to be pressure on the Fed and others to increase that liquidity to keep stocks going up. All right, surprise number 3, the bear and the maiden fair. U.S. equities conquered the world over the past decade as the S&P market cap now exceeds the rest of the world. Let that sink in. The S&P market cap exceeds the market cap of all the other stocks in the world. Amazing. The Economist magazine cover curse asks if investors should even bother with non-U.S. investing any longer. The combination of indexing flows, AI mania, and a 24/7 news cycle push U.S. equity valuations to extremes never seen before, not even in 2000 or 1929. The leather jacket-clad Jensen Huang has been elevated to rock star status, literally signing girls' tank tops, the fair maiden, and has single-handedly sent the bear to the ICU. Equity mania is so strong that U.S. stocks rose more over the last 2 years than any time in the last century. It's a long time. Investors, as so often do, piled in at the top. They didn't buy 2 years ago. They bought at the top and are now more invested than they have ever been before. Almost everyone believes stocks can only go up. Therefore, the surprise in 25 would be the bear takes some ivermectin, has a full recovery, and U.S. equities head down toward fair value. Now, here's the stat, 64 trillion for U.S., everything else 62. And if you look at the MSCI index, nothing else matters. 73% to the S&P versus Japan at 6. I mean, it's almost a joke. And it just has to do with market cap weighting, which is a silly construct to take the current price of 100 shares and multiply by the number of shares outstanding to get the market cap of a company. Actually doesn't make a lot of sense, but that's the way it is. U.S. equity is valued at more than 2 times Europe plus Japan plus emerging markets. Again, let that sink in. So if you took Europe and Japan and all the emerging markets, put them all together, doubled it, it would still be less than the U.S. And if you just pull out the tech part, it's even worse. So The Economist literally puts us on the cover, the envy of the world. So why should investors just give up on non-U.S. stocks? If you look at pricing, on average, the rest of the world sells at about 1.7 times book, which one could argue is still too high, right? I mean, probably 1 to 1.5 times book is more normal, but okay, let's say 1.7 is fine. The U.S. at 5.2, that's just crazy town. So the issue is the gains are mostly multiple expansion. So left-hand side is corporate earnings growth, pretty small, 6.5%. Price appreciation, 60%. So 10 times. Well, how is that happening? Well, it's happening because the multiple is now 30 times, right? Versus an average of 14 to 15. So, and if you just look at the top 10, it's even worse. So it's bad. Now, the last 2 years, as I said, are the best 2 years in the history of markets, actually since 1928, so not in the history of markets, but in the last century. And the rolling 12-month, again, if you look at that chart, there are no periods where you get to a high level of trailing period return and then go flatline, right? And stay at that level. There's ebbs and flows. So they say the trend is your friend. So what does Wall Street do? It predicts more of the same. So it's going to be up 12% because it was up 20% last year. It's easy. Now, S&P earnings have beaten expectations. But this is a game they play, right? It's like you're the high jumper and you take the bar off the rack, you put it on the ground, you step over it, and you call yourself the high jump champ. If you set the bar low enough, yes. But the problem is the estimates reflect extreme optimism for this year. As much as 23% growth. It's probably not going to happen. So sentiment on the left, so earnings sentiment globally is changing, right? In Europe, it's actually starting to rise because it was pretty dang depressed. And in Japan, it's kind of moribund, stuck around zero. But the US in dark blue has started to drop. Yet, if you go to the options market, optimism has never been higher. Everyone thinks stocks only go up. So literally, okay, not no one, but 90% of people believe that you could even have a 10% correction. And that's an amazing. Now, the reality is we haven't had a 10% correction for, 2 years. And people just remember the recent past. Portfolio managers, therefore, have the highest exposure ever. They're actually net leveraged. They have negative cash. And no one is buying protection. So small caps have underperformed, and they've underperformed by a lot. Now, I would argue the reason they've outperformed is because 40% of them don't make any money. The alternative view would be that they're super cheap, and if stocks are going to do well, then these will do better. Yeah, there is some logic to that, actually. Markets hate uncertainty. So we've had 5 straight weeks of losses until today. Risk premiums have risen. And now that, the inauguration is going to happen on Monday, and we'll get some clarification on executive orders and appointments, maybe things will start to get a little bit better. Equities gave back the entire MAGA surge. Now, that always happens. It's called a gap fill. So you can see right after the election on the left-hand side, we gapped up, and those gaps always fill. So we had to eventually come back down here, and we got to extreme fear yesterday. And so now, we're doing the presentation today, not yesterday, but, extreme fear is usually a pretty good time to buy. Now, what I find extraordinary is how every word that this guy says is hung on like it is the most important thing anyone's ever heard. So quantum computing became a thing in October when Google announced they had this Willow chip that they're developing, and it did this benchmark. Now, remember, the benchmark was created so that regular computers couldn't do it except for one, septillion years. And so it's basically to say, how fast can you process before you can't use a regular computer to check the work of a quantum? So it's kind of a rigged system, but they announced it like it was some big thing. And these stocks that had the name quantum in them went crazy. I mean, they just went ballistic. And Jensen came along and said at CES, well, if you told me quantum was going to be here in 10 years, I'd say you were crazy. If you told me 30 years, I'd say that was too long. So maybe 20 is right. And these stocks went down 70, 80% almost overnight. So one sentence wiping out tens of millions of dollars or hundreds of millions of dollars, actually. Anyway, so surprise number 4, the laws of gods and men. Fang Man was replaced last year by Magnificent Seven, Meta, NVIDIA, Google, Microsoft, Apple, Tesla, and Amazon. 2025 was deja vu all over again as Mag 7, there's another typo. 2024 was deja vu all over again as Mag 7 surged 2 times the S&P, which was up a strong 25%. Despite concerns about slowing growth, Apple, Microsoft, and Amazon, new competition, Google and Meta, as AI kind of came in, or insane valuations at Tesla and NVIDIA. Passive flows paid ever higher prices all year, pushing stocks to all-time highs. By year-end, the U.S. equity market had never been more concentrated. Technology valuations had never been higher. And yet, Mag 7 barely got any airtime as media now hangs on every word uttered by Jensen. Case in point, throwaway comment at CES, being 20 years away since stock market darlings down 75%. In 2025 would be investors awaken from their collective slumber, see the bubble, press the sell button, and MAG stands for must acknowledge gravity. So top 10 stocks rose 47%, 24. Equity concentration, literally never been higher. U.S. stocks are the most overvalued ever. Ever's a long time. And if you strip out technology, it's worse. But if you tried to short them, you actually suffered your largest loss ever, actually worse than trying to short them back in 2020. So the faith in AI is literally rivaling that of the dot-com bubble, and therefore U.S. equity exposure has now come back to that level, which didn't work out very well, if we all remember. So Mag 7 valuations on the left seem reasonable if sales growth can continue at double-digit rates. The problem is the estimates for future growth always tend to be significantly higher than actuality. So the forward-looking growth doesn't actually happen. And this happens every year, year in, year out. So we'll see how reasonable those valuations are a little later in the year. All of the S&P 500 growth is coming from the Mag 7. Is that sustainable? I don't know. I mean, the Mag 7 is supposedly going to grow earnings at 33%, the rest of the S&P at 3%. If you come into 25, it gets a little better at 18 and 11. So the answer would be it's not sustainable. And the question is, how far does that dark blue bar actually fall? So NASDAQ, if you adjust for M2 growth, which everyone says you have to do because you can't just do nominal price, you got to do deflated by the fact that the currency is worth less. I think that's useful. It's back to its 2000 peak, and the Mag 7 individually are bigger than countries. It probably doesn't make sense, but maybe. So in AI we trust, and Momo Tech is all the rage. The problem with these types of moves is escalator up, elevator down. When things change, when there's a mistake or when there's a miss or when there's a jump in, interest rates or something, they go down fast. So some protection is probably warranted. So NVIDIA is a good example. It's priced for perfection. But if they, and what I mean by that is because in the upper right, right, their PE only 53. People say, oh, but their forward PE is 30. Okay, but their price to sales is 29 and their price to book is 50. I mean, those are numbers that we just have never seen before. So price to cash flow at 86. So everyone's assuming that everything they do is going to be perfect. But the reality is they're going to deliver some of these Blackwell racks and they're not working. They're actually overheating and glitching. If that continues, this, plateau on the right could turn into, gravity rules. Palantir got a little taste of that. So Palantir on the left, I mean, you couldn't draw it to match the typical bubble chart on the right much better, right? Even if you just copied it, I mean, it's got everything from the first sell-off to the bear trap to enthusiasm to greed, delusion, new paradigm. They're in the denial phase and there'll be a return to normal, right? It's probably happening today. But eventually we're going to get fear and capitulation and ultimately despair because no matter how many contracts they get, this thing's way overvalued. There's not enough work in the government to justify their price. And now his watch is ended. Surprise number 5, the greenback was in full Bruce Banner mode for most of 2024. DXY was languishing around 100 in late September, down 2% calendar year to date. When something peculiar happened, the Fed just cut rates. Sentiment on the dollar was outright negative. Or the Fed had just cut rates, sorry. Sentiment on the dollar was outright negative, but remarkably, DXY went full Hulk mode, turned up hard, and flew higher as betting odds indicated Trump would triumph in the election. 4% in October, 2% in November, 4 more in December. Calendar year to date, 8%. That is a monster, literally, pun intended, move in DXY. Currencies all around the world were downright green with envy, or maybe they were puking, as no one could understand why Fed funds cuts had triggered such a violent transformation in the dollar. Consensus turned sharply positive. Hedge funds piled into long dollar like never before. The surprise would be the long-term trend in the dollar remains intact and DXY shrivels back to banner form. Another typo with an extra space. Look, the dollar's been in slow decline relative to the rest of the world since the 1980s. Since the Plaza Accord, we had the first tech bubble, and then we had the second tech bubble. But it's a long, slow trend downward, which makes sense. We printed too many of them. Now, these extreme rallies, meaning more than 6.5% rallies, when they happen, it's usually around financial crises or, coincidentally, MAGA elections. Why? Well, because of the threat of tariffs. So the trend is your friend. Goldman says, hey, if it went up 8% last year, it's going to go up another 5% now. And hedge funds are more bullish on the dollar than they've ever, well, not in any time since 2019. The strong dollar does not bode well for stocks. Historically, when the dollar gets strong, U.S. equities suffer. Why? Because 41% of revenue comes from abroad. These are global companies that just happen to be domiciled in the U.S. Now, keeping the recent dollar move in perspective on the left, it's not exactly dead over the last 5 years, but not a lot of movement over 5 years, a lot of volatility, but not a lot of movement. And yes, there was a 13% move off the bottom, but whether that can stay, and what you don't ever see is a jump up and then it stays. When you get these big moves, you eventually start going the other way. Surprise number 6, the house of black and white. Saudi Arabia has a problem with, seemingly, no easy solution, as they need oil at 90 to make their budget balance, but their athlete couldn't seem to jump past 75 during the second half of 24. Normally, one might point toward electioneering by incumbents to lower gas prices before the election, But more troubling for the Saudis was their inability to control the markets as they have for decades. Despite rising demand, overcoming global growth fears, the pesky problem was consistently high production from the U.S., mostly the Permian. The problem is U.S. production is out of the control of the Saudis. So their only option was to push prices higher, would be to reach for the shutoff valve on their own supply, which has never been the preferred option. They like selling oil. Consensus believes they will threaten, but not act. The surprise in 25 would be global demand surges on central bank stimulus. Oil prices jump past the Saudi line and actually hit 100. So OPEC made a decision in December to extend the cuts to 26 and to delay any increases by some of the smaller members to April, which meant that inventories that were expected to rise now won't. In fact, inventories on the far left, that little yellow arrow, are the lowest they've been in over a decade. Now, on the right, they are forecast to rise in the first quarter on lower demand, because of winter. And, next Wednesday is going to be the coldest day in the history of the United States, which is kind of interesting. But, that to me seems like there'd be more demand, but we'll see. Maybe just for natural gas. Oil prices surged following that OPEC decision, and WTI broke above this long-term downtrend. That's actually good. But EIA says, nope, everything's going to be fine. We're going to have flat oil prices because that's what the futures say, but that's what the futures always say. EIA, as always, says supply and demand on the left are going to be in perfect balance, and OPEC isn't going to use all this spare capacity and flood the market and push prices lower. Oil prices actually have been moving higher. So in the last month, they have risen a lot. Whether they can hold the 200-day, we'll see, and more to be written on that. If Saudi does reach for the shutoff valve, prices could rise. If demand turns up, prices could rise. Now, look, energy stocks are as out of favor maybe as they've ever been. I mean, maybe 2020 was worse, but basically no one likes them. Very contrarian, record low inventories, record high oil demand, sanctions. I mean, there's all kinds of reasons that people hate them. But many of the stocks trade at 15% free cash flow yields at $75. So investors pushed stocks to an extremely oversold level about a month ago, in the red on the left and in the green on the right. And it's been straight up since then. So that was a pretty good time to buy. Whether that will continue depends on the price of oil. And we love MLPs. They just generate free cash flow, and they're up another 5% already this year. Just great. All right. Surprise number 7, the red woman. Europe has a simple economic plan for nearly 2 decades. Invite all the weak currencies into the euro to drive it down, enabling mercantilism to thrive by selling cheap cars and machine tools to the developing world, particularly China. Problems began when inflation spiked after the massive global money printing in 2020, and more populist governmental programs increased spending, which forced Ms. Lagarde to hike rates, and the euro went the wrong way. Further compounding the problem were new protectionist plans to add tariffs to Chinese EVs in response to a total collapse of European auto sales as China expanded domestic car production. Here's a stat. It's kind of hard to believe. 15 years ago, China made 1% of global cars. Now they make 39. It's an amazing stat. Ms. Lagarde has done about face and is frantically cutting rates to weaken the euro. It's working, but is it too little too late to save the U.S. economy, the EU economy from recession? The surprise would be that crafty Christine finds a way to outcut the global central bank cutters, and European stocks outperform. So she does her own version of red wedding. All right. EU GDP growth, it's the worst in the world. It trails even Japan, and that's saying something because Japan isn't even running very hard. Now, it's worse than that. because the EU is diverging basically into two units. You've got peripheral Europe, which is actually recovering and growing faster, and core Europe, which is, we'll call it populist Europe, France and Germany, and they are really struggling. And in fact, arguably are in recession, not even near recession. Now, Ms. Lagarde cranked the money printer back to maximum burr, but is it too little too late? I mean, can credit growth on the far right, you can see the massive spike up in European credit growth, but will it be enough to save them from recession? Now, Germany has this problem that they're finding out the hard way that trade wars are not that easy to win. So they are, you can see the green line on the left, they are now selling less to China. Now that's because China basically said, all right, we used to buy all your Volkswagens. If you went to China, they were all Volkswagens. But, now we can produce cars cheaper than you, so we don't need your stinking cars. So look at, European car companies. They've been a total debacle. And Germany is exporting to the U.S. Well, Trump has basically said, no, we're not going to take that. So we're going to slap, even though you're our friend, we're going to slap tariffs on you too. So German factory orders just dropped more than expected. So that's not good. On top of it, it's entered full-on recession. I mean, industrial sentiment is as low. Every other time it's been this low, there's been a recession. Again, just this morning, they entered their second contraction in a row. So technically they're in recession. And the number unemployed has risen every month for 2 years. That's a bad number. All right. Mercantile states need weak currencies to thrive. Wish granted, but is it too late? So yes, the euro is headed to parity, but is it too late to save them? European stocks, dead money for the past year. Export businesses, Volkswagen, Porsche, BMW, Airbus, worse. Now, I'm not saying you should rush out and buy German auto companies. The culture of equity ownership is just not strong. And you look at the UK and the Europe, 10% versus 32 in the US. And stocks trade at a 45% discount to similar price stocks on a 12-month forward PE basis in the US. So probably a place to go shopping. And despite, again, another typo, ECB cuts, Bunds caught in the global bond sell-off. So Ms. Lagarde cut rates, German bond rates go up. Why? Well, because China's selling their bonds, which we'll get to in a little bit. Now, that is saving the banks. The banks were in a world of hurt globally, and rising rates actually helps them because their net interest margins expand. So unlike European stocks, which have been dead money, Deutsche Bank, which is not even that good a company, has been doing pretty nicely. All right, surprise number 8, a night of 7 kingdoms. And I'll accelerate because I know I'm over. Since 2011, Japan has had a very simple economic plan, Abenomics, weaken the yen through Bank of Japan programs like QQE, and everything will be fine. The plan worked quite well if you're measuring stick as Japanese equities, Nikkei 225, which 5x'd over 13 years from 8,000 to 40,000 as the yen was just karate chopped from 80 to 158. If you measure success on GDP or inflation, results are more muddy. Japanese GDP has languished. CPI has been more deflationary than inflationary. Everything changed in April 23 when big wave surfing hero Haruhiko Kuroda-san was replaced by academic Kazuo Ueda. Kaz suited up and looked for things to break. He likes to karate chop. First up was rates. He boosted the yen, busted the Nikkei. So Prime Minister Ishiba had to sit him down and say, hey, dude, whoa. And whoa translates to whoa in Japanese. I checked. Surprise in 2025 would be that Ueda's academic discipline leads to further hikes, a stronger yen, and the sun sets on Japanese equities. Japanese GDP growth is just, And part of that is demographics. Part of it is bad management. Part of it is they don't really care because life is pretty good for the average person. Real GDP growth is just going to languish at 1% for a long time. Leading economic indicators, they're actually going the wrong way. But Ueda-san says, I don't really care. I'm going to raise rates, and that's going to raise JGB rates. And the problem for all of that is insurance companies and the government, and particularly the Bank of Japan, own tons of these bonds at zero. So they're going to lose a lot of money. I don't know who's going to pay for it. So Ueda-san doubles down on the rate hike policy. He says he's going to rate hike again. And what happened? I mean, that is a big negative candle, 158 to 156. Now, we're still at 156, so we got a long way to go to tighten the yen. But if the yen tightens, look out below. So after decades of deflation, inflation is back. Is that really a good thing? It depends who you ask. Inflation is theft. Japanese corporate profit growth down to zero. And earnings sentiment is zero. So it is the only place in the world where there's more upgrades than downgrades. So that's something, but it's not looking great. And therefore, Japanese equities have been dead money for a year. The last thing they need is a higher yen. Surprise number 9, the dragon and the wolf. Emerging market equities underperformed U.S. equities for over a decade, surrendered all their excess performance from the 2000s. Despite faster GDP growth, better demographics, and oftentimes higher earnings growth, EM equities have failed to gain broad global investor acceptance, and EM valuations have languished versus their U.S. counterparts. China in particular struggled mightily since the Biden administration took over, surrendering all excess returns earned in the previous decade. After a tough 2023 and early 2024, PBOC pulled out the stimulus bazooka to prop up a flagging property market and reinvigorate a stagnant economy. As we thought might be the case last year, the dragon market roared in the year of the dragon and beat the SPX. But the surprise in 2025 would be that China confounds the skeptics who think Trump tariffs will thump China stocks, and the Shanghai index continues to fly. So EM equities, they gave it all back, but now they sit at 50-year lows on a relative valuation. It's pretty good. Another perspective would be that EM equities on the left, the green line, the straight green line, have been consolidating for a long time. And on the right-hand side are at the super cheap, undervalued zone of their upward channel. Probably a good time to buy. China equities also given back all of the excess return of the 2000s, and they sit at 30-year relative lows. But it's curious. Chinese equities, much higher earnings growth, 17 versus 7, yet U.S. stocks are up 58%, Chinese stocks up 0. Just weird. So not many people talking about China beating the S&P in 2024, off to a pretty rocky start in 2025. The media says it's just a matter of time before the CSI 300 and the Hang Seng collapse, just like the World Index and the Emerging Markets Index say they should, because on the right-hand side, government bond yields are collapsing and the renminbi is collapsing. Well, why is that necessarily a bad thing? If you think about this, deeper analysis says maybe there's method to the perceived madness. China is the largest owner of U.S. treasuries, yet their ownership just hit a 14-year low. So if they are actually selling U.S. bonds, what happens? Well, U.S. rates rise, which causes a big problem with interest on a $36 trillion national debt. Does that give them leverage in the trade wars? Is she really that smart? Lower rates in China also mean more capacity for the PBOC to inject liquidity through purchases. So they have become huge net purchasers of government bonds and are injecting liquidity to prop up the economy. And given how far yields have fallen, they have lots of capacity to do it some more. But that's going to weaken the renminbi. Well, maybe that's what they want to do, because who's laughing now? Maybe the weak renminbi was part of the plan all along. Their trade surplus just hit $1 trillion. Whoa, 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 whoa. What? What? That's not what was supposed to happen. Chinese equities bounced nicely off the 200-day. Super cheap, both MSC, MCHI, and A shares. Chinese tech stocks, even cheaper. Companies like Baba and Tencent, I mean, they trade at silly, silly levels relative to U.S. tech stocks. Probably some interesting relative value trades. All right, surprise number 10, the breaker of chains. Bitcoin was the best surprise in 2024, again, as the ETF approval stimulated new demand. MSTR initiated the 2021 plan, issuing $21 billion of equity and converts to buy Bitcoin. The April halving cut block rewards, which combined to push BTC prices past the target 100K level. Institutional adoption rose as fiduciaries found comfort in familiar structures to buy and hold this new asset class. Bitcoin turned 16 on January 3rd and celebrated with a $1.9 trillion market cap, up from zero in 2009. It's pretty good. With that success, consensus emerged that the 4-year cycle of spring, summer, fall, winter was over, and Bitcoin prices would be up only going forward. Adding fuel to the fire is the incoming Bitcoin president, who pledged to create a strategic Bitcoin reserve and a crypto-friendly administration. The surprise in 2025 would be, unfortunately, the 4-year cycle still exists. Humans are going to human. Winter returns. Prices peak at 150 and fall hard in the second half of the year. Why, yes, Bitcoin was the best performing asset class again in 24. Investors are chasing the hot dot, so they're piling in to the CME futures. Now, part of that is misleading in that a lot of that is also people selling the future against the long IBIT position. But a lot of people piled in chasing the hot dot. And the consensus is, yeah, there'll be a small pullback, but then up only. And the cycle is gone. Don't really buy that. Now, look, there is a long history of Bitcoin crash stories. So, Bitcoin's crash last week from $237 to less than 100. Okay, that was a long time ago. Then Bitcoin crashes below 1,000. Then Bitcoin crashes below 10,000 as fears mount of regulatory crackdown in Asia. Then crypto markets crash after epic rally, sending Bitcoin back below 100K. Really? So here's an interesting fact. No one who's held Bitcoin for 4 years has ever lost money. No one. And no one has ever underperformed the S&P over 3 years. Pretty good. In fact, substituting Bitcoin for tech exposure in a portfolio is wildly accretive, because not only does it have better returns, like significantly better returns, it actually is uncorrelated to the rest of your portfolio, so your Sharpe ratio goes up. Now, Bitcoin has methodically followed the 4-year cycle since inception. Okay, so you start with spring, summer, fall, winter. So spring, things kind of, that's the orange. And then summer's kind of meandering. And then fall is when all the good stuff happens. And winter is bad. So 2024 was very similar to 2016. Okay, following the 4-year cycle very well, which means 2025 would be like 2017 or 2021, which were both really good years. We're in the 5th Bitcoin bull market. the implied compound annual growth rate of 136% over that 3-year period ends in 2025. Okay, check. So where are we today? Well, we're right on the long-term trend on the left, if you look at log scale. And on the right, if you compare the red line to the previous cycles, we're right on track. All right, bonus surprise number 11, and I'll let people go. Golden Crown. Gold, surprisingly strong year in 2024, jumping 20% despite headwinds of a stronger dollar, capital flight to other stores of value like Bitcoin, general lack of attention as investors so smitten with Mag 7 and AI. Gold quietly took out the 2,500 level to not much fanfare in September, drifted marginally higher over Q4, delivering on our bonus surprise from last year. Heading in 2025, one might logically conclude that with Trump threatening trade wars, dollar surging like the Incredible Hulk, and Bitcoin at 100, all the glitter might be gone from the barbarous relic. The bullion bulls on the right would beg to differ, and whether it's adorning themselves with more bling, lounging on the beach, spending their Krugerrands, or stacking some bars in the safe, the surprise in 2025 would be that gold continues to wear the crown as the ultimate store of value and prices top 3,000. So we are entering the boom part of the economic cycle that favors commodities broadly. Dr. Copper has made a big cup pattern rounding bottom. If it can take out the 200-day moving average, Dr. Copper would concur that it's a good time to own commodities. Gold tends to glitter more brightly after rapid dollar moves, then declines. So we just had a big rapid dollar move, and so we could see a 25% move in gold. Something has changed in the past 20 years. We used to have 20 to 30% of global assets were gold and gold miners. It's an amazing stat. Now it's sub 1%. Is that an anomaly or a permanent change? I don't have the answer, but it's an interesting stat. Many factors stack up to say this is going to be a bull market year for gold. This is all Tavi Costa's work at Crescent. Around the world, we'll put this up on the podcast site. You can also get to hedge. We did a great one with Infinitum, talked about Grok. X and I are there every week talking about what's going on in the digital age, helping listeners stay current. And I still like these books. I will see if there are any questions. All right. Oh my gosh. Thank you. Byron passed away. I shows how much I know. I should have been more cognizant of that. Thank you, Randy, for telling me, and I will modify my slide now. And rest in peace to Byron. Second, have you considered the U.S. is radically weakened in purchasing power and therefore stocks should go up? Stocks are living in a world where it will continue to go up. Net. Okay. So, I mean, it's a great question. So is it possible that we're going to live in a nominal world and they're going to keep printing dollars and everything is going to go up? Real estate's going to go up. Stocks are going to go up. And inflation's really, going to be running at, 4 to 10%. Sure. I mean, I think we're in that world. And I think, if you look at equities, even though it says we're at all-time highs, we're really not if you price in gold instead of dollars. In gold, we're at the same price we were in 1996. If you priced NASDAQ in M2, given that, half the world's dollars were printed in the last 5 years, it'd be a whole different story. So I totally agree, Anthony, that it's certainly possible that nominally we just keep piling into stocks. The boomers keep buying on autopilot. What is going to change, right, is, every day, sadly, about 7,000 boomers pass. And that's, the nature of life. And, that's going to go on for the next 20 years. And eventually all the boomers are going to be gone. And those boomers, that money, that $39 trillion is going to start to be spent in retirement. But it's also then going to get transferred to younger generations. And historically, the government takes a cut in taxes, which that's less good. And then, younger generations will spend some of it too. So I don't know. I think it's probably likely that people change the way they invest, and that cap weighted equity indices aren't all the rage over the next 50 years as they have been over the last 20. Just be my guess. Can we deck for sure? It's a little tricky. So Greg, send an email to Erica and we'll get you a link. The way we have to do it is through Dropbox because the file, Microsoft has this bloat problem. But yeah, the answer is yes, we can get you slides. Are you expecting fiscal drag as Republicans don't do what Trump wants? Again, great question. So I think it's certainly possible that there's a lot of talk and not a lot of action coming out of the White House. Absolutely, I think that's possible. So could the deficit shrink? Could spending shrink? Yeah, although I think the Republican majority is still strong enough in the Senate to keep the House at bay. But it's a great question. Do I think MSTR strategy of continuing to sell convertible bonds to buy Bitcoin is sustainable? Yes. When Bitcoin crashes, it could be a real issue. So here's the thing. So again, great question. But just like in the last crash, the difference between convertible bonds, which are unsecured, versus borrowing against your Bitcoin is if you borrow against your Bitcoin and pledge it as collateral and the price drops, they can seize your collateral. Here, the convertible bondholders don't have any claim on the Bitcoin. They have a claim on the company. And so there's no margin call. And so what we saw in the last cycle was Michael could just quietly sit and wait for prices to recover. Now, I also think that the downturn this time will not be as severe as the last three. So when 84, 84, 75, that's still above most of his cost basis. So he'll have no problem. Thanks for the compliment on the presentation. AI agents and their future. Oh my gosh, we could talk about this all day. AI is here. And, again, I've talked about this 75-year overnight success story. There's a lot of positive things about AI, a lot of negative. I mean, you saw the hallucinations in the ChatGPT graphic. I mean, that was horrible. You've seen the videos of people with 7 fingers and the like. So it's not perfect, but it's good. AI agents are kind of the next iteration where we get tools. I'll give you a great example. So the other night, I was trying to make the decision to go to the, national championship game on Monday. And I'm having a conversation in a agentic world. While I'm having that conversation, an AI agent should have gone out and found me a plane ticket and a hotel. Now I can do that with an app, but an agentic world would have a literal AI that's listening to me while I'm on my computer, like it does anyway. And it would have done that task, and that would have saved me some time and maybe even saved me some money. So I think there are lots of real use cases like that. And whether it's doing, tasks, like AI is never going to make my presentation because, right, I finished my slides at 3:45 to present at 4, and it doesn't know, I don't even know what I'm going to get until I get there. So I don't think agents are going to do everything, but I think there are a lot of use cases. And then physical AI is another one that I think will be huge. So What should Jay Powell have done in 24? I think he should not have cut rates personally. Again, I think that's a great question. I I think you don't cut rates into a 2.4%, growth economy, because what you end up doing is, in my mind, stimulating the wrong kind of inflation. Now, again, if you want to take the sinister side and you say, well, remember the goal of the Fed is to transfer wealth from the masses to the rich, then it's exactly what he should have done, because now he's, again, enabling people to refinance their bad real estate loans at cheaper prices. So it's all about incentives. So that's fine. All right. So thanks, Anthony, for the hung on Jensen's every word. Jason Hung, Hung and Wong. I like it. I didn't mean that to be a pun, but I like it, and I'll use it next time. That looks like all the questions. I'm way over time. Thank you, thank you, thank you. If you have other questions, don't hesitate to send them to Erica, and we'll get you an answer. And we will be back soon with more around the world. Thanks again.